Ladies and gentlemen, welcome and thank you for joining today's web conference, Got Parametrics, Innovative Solutions for Nat Cat Perils. Please note that this call is being recorded. Please note that all participant lines will remain muted until the Q&A portion of the call, and we will provide you with instructions on how to ask a verbal question at that time. You are welcome to submit written questions throughout the presentation, and these will be addressed during Q&A. Please use the Notes tab on the bottom right-hand side of your screen and address your question to all moderators. If you require technical assistance, please send a note to the ATT CES operator. And with that, I will turn the call over to David Langman, Lead Origination in the Innovative Risk Solutions team. Please go ahead.
Thank you. And as part of the Innovative Risk Solutions team, it's always nice to note that our acronym is IRS. So it's a name that will stick in your mind in more than one venue. Thanks for making the time today to discuss Got Parametrics. I, along with my colleague, Bob Nusslein, hope to give you a to-the-point, insightful conversation regarding an innovative approach to address cat peril risk. And a couple of introductory comments. Parametrics are a very innovative solution that involves we use the term a capital market-like or cat bond-like trigger to respond to cat peril events. And we mean cat perils like windstorm, earthquake, tsunami risk. Unlike traditional insurance, it's a formulaic response to a stated cat peril in a specific geography. The contract tends to pay with almost immediate liquidity, and when we use the term immediate, we say within 30 days, and the proceeds can literally be employed for whatever the client needs them for. They're not restricted to quote-unquote indemnifiable loss. We're really at a second generation of these structures to further refine how our contracts respond to cat perils. We can be a lot more precise than first generation models, and my colleague will show you how. We can create a better linkage between the magnitude of a cat peril event and how it impacts your exposed assets, as well as the speed of a recoverable. And we can do these structures either as a derivative contract or an insurance form. So we give you some real flexibility as to contract design. To better explain what a parametric is and what is not, the best way to do it is to compare it to traditional insurance. Compare it and contrast it, and that's what this slide does. And the base model in traditional insurance, when you really look at good old property insurance, you require insured assets, you require loss or damage to those insured assets by an insured peril, earthquake, in this case, earthquake or windstorm, that results in indemnification for the loss. A second critical point is business interruption is only covered as a direct consequence to having damage to insured property. And I think we all know there are plenty of scenarios where a cat peril event can occur. You have little or no loss, direct damage to your properties, but you could have enormous consequential loss. And that's one of the great limitations to traditional property insurance. And by the way, there's proof of loss to gain a recoverable, and you are paid on an actual loss sustained basis. Now, let's change the playing field a bit. Number one, parametrics are index-based products versus actual loss sustained. At a very basic level, this is a critical point, we literally don't care about insurable loss. We don't care about what assets you have in the geography. All we care about is the event, a well-defined cat event of a certain magnitude within a pre-agreed territory. That's it. And that's basically when we use the term that the event parameters are met or exceeded. That we have a hurricane, it's a class 2 or a class 3 within a certain geography. We don't struggle at all with insured assets insured loss, indemnification, event parameters. That's all we're interested in. And the payout, equally as critical, of a specified amount is based on those event conditions. It's pre-agreed, and the best part of it all, it's formulaic. Those of you that have ever gone through prosecution, shall we say, of a business interruption claim, a traditional BI claim, it can take a long time, require a lot of elaborate paperwork. In the world of parametrics, it's pre-agreed, upfront, formulaic, and if you hit the event threshold and the geography, we pay. And typically what we're dealing with of event thresholds is we're dealing with wind speed intensity within a geography. In this case, we're mentioning latitude and longitude coordinates, or earthquake shake intensity, which is actually a better proxy for potential damage to your structures than using what we call conventional Richter scale type event parameters. And then the last comment here is that more often than not, when we use event parameters, we tend to have a two-tiered threshold. The idea being at one level of wind intensity, we pay some portion of the contract value. At a higher wind speed, we provide 100% payout. It's a parametric at its basic level can be a wonderful complement to a traditional insurance program. It is much more concise in terms of responding for economic loss if you hit the event threshold parameters. Some clients use them purely for a BI issue. Others use them for some combination of the recoverable for business interruption, deductible buy-downs, uninsured losses, sublimits. Again, from our standpoint, you hit the event parameters, the payment's made. It's simple, it's elegant, there's no formal proof of loss required, just that the CAT event happens in the geography and at the intensity pre-agreed. Let's go to the next slide, please. Okay, what is a parametric insurance problem? So we've talked about predefined event triggers and a table of payout factors. Obviously, the final contract is agreed to contain the details of the transaction, including the trigger, the threshold, and the magnitude of the event that has to occur. We specify a payment horizon about how quickly we actually will provide a payout, and typically it's done at or within those 30 days. And we also can give you the flexibility to buy it in a pure form, a formulaic, we call it a derivative, but we can also sell you the product with an insurance wrapper, which for some clients is very important, that they still want to acquire the contract in an insurance form, and ultimately all we do is add a second dimension to the contract, that not only did the event occur and it was of a certain magnitude within a certain geography, but we also add this second element of conditionality, that the monies you receive are actual covered losses and expenses. You're getting true indemnification. Now, admittedly, that is what I would call a limitation that you're providing on a parametric. But the reality is some clients cannot accept a contract like this in derivative form, are much more comfortable in providing in the insurance form. Next slide. Okay, key drivers for buyers. And I'll preface this with the buyers that we've done deals with have been through any number of industries. We've done deals in the energy space, dealing with offshore energy assets that are looking for a recoverable for economic loss with an emphasis on immediacy and payment. We've done some for power generation providers that have transmission and distribution line exposures that cannot be easily insured through the conventional insurance market, if at all. that these T&D risks can often lend themselves well to a parametric type product. We've done them in the public sector for deductible buy-downs and also a liquidity source that provides immediate post-loss funding for emergency purposes. We've used them in higher ed. Interestingly enough, we've done transactions for clients that don't buy any cat peril coverage at all, but still see a profound need for a significant source of liquidity post-cat event. They know that in spite of the fact they haven't bought any insurance, they're going to suffer an enormous loss, and they'll have certain immediate needs that a parametric can respond to that oftentimes traditional insurance won't provide the speed of a recoverable. Use them in the healthcare industry, the real estate industry. It's really not driven as much by an industry as it is A, an exposure to a cat peril, B, the need for immediate recoverable, and the avoidance of a lot of conditionality around that recoverable that shows up with traditional insurance. Again, payouts done within 30 days. You have the opportunity to employ those proceeds in any number of ways. There's no limitation. Unless you add an insurance dimension, there's literally no limitation. You hit the threshold and cash shows up at your doorstep. We often see these products employed to cover both uninsured or underinsured risks. Clients seem to like them immensely because of the simplicity and transparency in the claims process. And then the last piece is, as I said, that we have any number of clients that have huge exposure to cat peril risk, have pretty much left conventional insurance behind, but still openly acknowledge that they have immediate liquidity needs for post-event emergency costs and evacuation orders. So those are some of the dimensions that drive the decision to employ parametrics, either in addition to traditional cat peril coverage or in scenarios where clients buy no cat peril coverage. Now, just briefly to just compare and contrast to traditional insurance, I think you can appreciate that with a traditional property form, you have to have loss or damage to a physical asset. You have to be indemnified for it, and you have to have the linkage between direct damage to your asset and consequential loss. When you migrate over to a parametric, again, we don't care at all about insured assets. We don't care about if those risks are hardened for the earthquake or the windstorm. All we care about is the event, the probability of the event occurring at a certain threshold within a certain geography. Recovery, again, a traditional insurance product, it's proof of loss, indemnification, actual loss sustained. Those are very common terms used in the claims process. You migrate to a parametric, it's pre-agreed, it's formulaic, it's based on event parameters, and it's within 30 days. The term, and we love to use this in the insurance business, basis risk, in theory, when you buy an insurance contract, you should get a linear payout, that you have direct damage, and ideally you have direct damage coverage on a replacement cost basis, plus adequate limits for consequential loss. Assuming you have adequate proof of loss, there shouldn't be any basis risk. You should be paid exactly against the actual loss sustained. Migrate from that world into all we care about are event parameters, the magnitude of the earthquake, the magnitude of the windstorm. As you can appreciate, there's not 100% correlation between the event occurring at a certain magnitude and the liquidity you receive as compared to your, quote, indemnifiable loss. And it is theoretically possible that you could construct a parametric where you didn't set the threshold low enough, and under a normal insurance policy you would have received a recoverable, and under a parametric, because you haven't hit that threshold, there would be no payment. And conversely, you could have scenarios in which you had no real loss or damage, but the threshold was set low enough to where you received an immediate liquidity payment without regard to indemnity. That is both the virtue of the product as well as the limitation, term basis risk. Loss assessment and payment, and those of you that have ever been through a business interruption claim can testify it can take a long time to provide adequate proof of loss to get information and collect your proceeds. Clearly, in the parametric world, it's virtually immediate. It's within that 30-day period. And for some clients, particularly clients that are exposed to large cat peril risk and they're highly leveraged, which requires periodic debt service payments and a real risk of default if they don't meet those debt service payments, the simplicity and speed and transparency of a parametric payout is oftentimes preferred over a traditional insurance payment. Structure, insurance contracts, standard wordings, contract wordings. We have a lot of, I'll call it, optionality in a parametric to customize the features to it to make it fit better to your liquidity needs or to assets over a much larger geography that might be exposed to a cat peril risk. I would tell you that we've come a long way in our parametric optionality. And the form of the product, obviously traditional insurance, using all those wonderful insurance terms, and under a parametric, we can give you purely in a derivative form, or we can wrap it with an insurance wrapper. And with that, I'd like to turn it over to my colleague Bob to talk a little bit about real-world transactions we've done in the space and how the product actually performs. Bob?
Thank you, Dave. This is Bob Nusslein. I'm the head of our Innovative Risk Solutions team for the Americas, located here in Manhattan. So what we're going to go into now is really the evolution of parametric Nat Cat covers. The first generation of covers were called cat in the circle or cat in the box covers. And we'll provide a couple of examples to show what those were and why they evolved and the advantages of this evolution. So here is a first generation cat in the circle California earthquake cover. The way these programs have been designed are an area is determined, agreed to between insured and insurer. In this case, you could see it's Northern California, a circle centered around downtown San Francisco and probably 75, 80 mile an hour radius, 80 mile radius to the circle. So what Dave talked about earlier too is in parametric contracts, a payout schedule is determined and agreed between insurer and insured. You can see on the left side of this slide, you can see USGS magnitude scale. Anything less than 6.7 magnitude, there's no payout. So the parametric cover is triggered for events greater than or equal to a 6.7 magnitude. And you could see this is what's called a stepped up payout, where it gradually increases as the severity of the earthquake event increases. So for a 6.7 to everything less than a 7.0, it would be a 20 million payout, 50% of the limit. And for events greater than or equal to a 7.0, in this example, it would be a 100% payout of the 40 million limit. And there's the potential to structure these in many, many different ways, with lots of steps, a few steps. Just one all or nothing payout is called a binary payout. That may be for an event greater than or equal to a 7.0, you get 100% 40 million payout. So now, as examples of how this first generation cat in the circle earthquake product works, you could see example number one. It is a 7.0 magnitude earthquake. The epicenter of the quake is just south of San Francisco. And if you look back over on the scale, so for an event of greater than or equal to 7, you would have a 40 million payout. You could also see that the epicenter is in the described area. So example number two it highlights actually the near miss factor of cat in the circle first generation parametric covers. You can see here There's a very large event, a 7.5 magnitude earthquake, and it occurs just outside of the circle, a little northwest of Gilroy. But you could see, because it's outside of the described area, there's no payout at all. So this is one of the maybe deficiencies of the first generation cat in the circle covers. The motivation of this client, they had a significant amount of assets in the East Bay, on the peninsula, just south of San Francisco, and in and around the San Jose area. So for the most part, the described area works very well. However, there is the potential for a near-miss factor, as shown by example number 2. Example number 3 is a 6.8 magnitude earthquake. It occurs inside the described area, and it's in the middle band of the payout schedule, so it's 6.8. So it's greater than or equal to 6.7, but less than a 7.0. So insured receives a $20 million payout. So that's the basic cat in the circle structure. Very simple, probably more simple than traditional insurance. But it highlights how it works, and then maybe the slight deficiency of the near miss. We'll go now to the same example for hurricane risk. So you can see, same described area, this time centered around New Orleans, or a point just north of the city, right on one of the banks of Lake Pontchartrain. And you could see also, in this case, it's not a magnitude trigger, but it's a hurricane category intensity trigger with the same payouts as the last example. So for anything less, any named windstorm, hurricane, lower than a Cat 2, there's no cover. For a Cat 2, there's a 50% payout, and for a greater than or equal to Cat 3 storm, there's a 100% payout of $40 million. So we'll keep the examples simple here. The first one is a Category 2 hurricane, and it just misses the described area. So in this case, similar to the last case where the epicenter of the quake was just outside the circle, there's no payout here as well. In example number 2, you have a Category 3 hurricane where it tracks through the circle just south of New Orleans, and it hits, and the Cat 3 intensity storm pays 100% payout, or in this case, $40 million. You can see a little Saffir-Simpson scale right there to show the categories and wind speeds as you review the slides after this presentation. So those are the first generation cat in a circle products. They're still employed today. We still use them. They work very, very well. However, the product has evolved to what we feel are more efficient, better structures for most cases. And what those are the shake intensity for earthquake and wind speed exceedance for hurricane. And what we call these products are our Swiss Re Quake product for the shake intensity earthquake cover, and Swiss Re Storm for our hurricane wind speed exceedance at specific locations. Okay, so we'll go on to the next slide. We'll have a few examples shortly. But now, why did we evolve, or why did parametric products evolve to something different than cat in the circle, cat in the box, since they work reasonably well? Well, for earthquakes, magnitude or a magnitude trigger doesn't necessarily capture localized impact or damageability as good as shake intensity at specific sites. Remember, in the example we used, the epicenter of the quake needed to be in the described area. But energy or magnitude is measured only at the epicenter. So you could have a moderate-sized magnitude earthquake just below your the client or your client's assets, or you could have a very large quake far away, like in the cat in the circle example, that 7.5 that occurred near Gilroy outside the circle. Both of those events could cause similar damage at the insured's locations or at their assets. So a better proxy for direct and indirect financial loss is shake intensity or ground shaking at the specific facility or asset rather than magnitude of where the earthquake occurs. So again, for the Quake shake intensity location-specific cover, we use USGS Shake Map, and we'll talk a little bit about Shake Map momentarily. And as we talked in the cat in the circle example, where payout was based on exceedance thresholds for magnitude, for this Quake product, shake intensity based, the payout is based on severity of ground shaking measured at specific locations according to USGS Shake Map. Now, just a little bit on magnitude versus intensity. Everybody's familiar with, well, more familiar with magnitude. Whenever there's an earthquake, we see on the news, everything's reported in Richter scale or magnitude at the epicenter of the event. So that's more common. USGS reports that scale as well. But intensity, shake intensity of the quake, is reported in different metrics, and there's three main ones. There's a few others, but the main ones that are employed by us and others are the Modified Mercalli Intensity Scale, MMI, Peak Ground Acceleration, PGA, or Pseudospectral Acceleration, PSA. Very scientific sounding, possibly slightly daunting words, but it's just another metric, another method of evaluating an earthquake. In this case, not energy released at the epicenter, but ground shaking intensity at a specific location. Okay, I think we'll move on. Okay, so this is a picture of a USGS shake map, and the example that we're using is the Loma Prieta earthquake in 1989. The epicenter, you could see on the colored picture or graph to the right, you could see just east of Santa Cruz a red star. That was the epicenter of the Loma Prieta earthquake in 1989. Now, this picture is color-coded, and then the color codes are outlined in the table below. That's the MMI table. So you could see the severity of the quake on the right side, or the shake intensity is greater where it's red. It gets slightly less into orange. As orange goes to yellow, it's slightly less, and then to green, to blue, to purple, to white, where nothing is felt. So it is a very intuitive table that's used, from nothing felt to moderate to strong to very strong to extreme. And potential damage, none to light to moderate to heavy to very heavy. So you could see the MMI scale, unfortunately also, like magnitude, does go 1 to 10. But you could see it is quite intuitive and goes from modest to severe depending upon shake intensity at locations. So you could see all over the Bay Area for the Loma Prieta quake, you had very severe ground shaking closer to the epicenter, even very severe ground shaking, quite frankly, quite far away. And as everyone remembers, or most people remember, Loma Prieta caused very severe damage in San Francisco, the East Bay, very, very far away from the epicenter down in the South Bay. So that's a shake map. That gives you a picture. Now, behind the picture is an enormous amount of data points that show shake intensity at a very high resolution of all types of latitude, longitude, coordinates throughout that entire area, reflected in a very, very simple picture. Okay, the next slide will give you a very high-level example of a parametric earthquake shake intensity transaction, also for Northern California. This one's very simple. It's a parametric earthquake property insurance policy, so in insurance form. It's for a single location in San Jose, California, zip code 95113. In this case, the policy term could have been anywhere from 1 to 3 years, non-cancelable. 3 years was the actual term in this real example. Swiss Re's share of the program was 100%. The limit was $50 million per occurrence and over the 3-year for a term aggregate limit. And the payout is based on the MMI, Shake Intensity, Modified Mercalli Intensity Scale, for that latitude, longitude centroid of the zip code 95113 where the location was. So the MMI scale, 6.5 to 7.49, paid out 25% of the limit, $12.5 million. The MMI 7.5 to 8.49, a much more heavier shake intensity quake, would pay out 50%, $25 million. And then a very large, 8.5 or greater MMI intensity, would have paid out 100% of the $50 million limit. So in the Loma Prieta earthquake, there were 8.5 recordings or greater at specific insured locations that would have been paid. Okay, simple, very simple example, one location, step-up payout. It could have been binary. It could have been a much more gradual step-up or just a two-step process. So lots of flexibility with how the payout factors are structured. Okay, so we can move away from earthquake now, and the same principles or issues that we talked about for earthquake apply to hurricane as well. So for example, going back to the cat in the circle example that we talked about before, you needed the storm to track through a specific area. So where the eye, excuse me 1 second. I'm just getting rid of a note that popped up. Bear with me 1 second. I'll just move it, I guess. Okay, sorry everyone. So just like with earthquake, windstorm, wind speeds at specific locations are a better proxy for loss than where the eye of the storm tracks through a specific area. So just like with quake, there is the potential for a cat in the circle structure to have a near miss, like we saw in the New Orleans example. So in this case, what we're gravitating away from is that described area. So we're able to locate latitude, longitude coordinates in zip code centroids that are at or near, very close to specific locations for the insured. And we measure wind speed at those locations, and if wind speeds exceed certain thresholds, payouts are made like Dave talked about earlier. And wind speed at location is a far better proxy of loss than storm eye tracking through area. So you could see in these two examples, the top picture represents Hurricane Andrew, and the bottom picture represents Hurricane Wilma. Two very different storms. Hurricane Andrew was a small storm, but an extremely intense storm. Cat 5 offshore, Cat 4 as it entered land. But it was a very small area that it covered. So if you had a cat in the circle structure and the eye of Andrew tracked through that area, you would be fine. You'd get a payout, very high wind speeds tracking through that area, and it was a good proxy for damage with assets in that area. However, you could have a storm, a hurricane like Wilma. Wilma was very different. It was a very, very large storm, more similar to Katrina than Andrew. It had intense wind speeds at the eye, but it had very intense wind speeds far away. So in that case, a wind speed exceedance trigger at specific locations would be far better for the insured than a cat in the circle structure. So now how do we measure wind speed exceedance? Wind speed exceedance we measure using HWind Scientific. HWind Scientific was now purchased by RMS, so now it's called RMS HWind. And we will talk a little bit more about that on the next page. Okay, so just like we showed the USGS Shake Map for earthquake, we're going to show the wind footprint produced by HWind. So the data that HWind uses is from all different forms. It's including land data, sea, space, airborne resources, satellite, reconnaissance aircraft, drones, buoys, weather stations. They take all the available data and in addition to that also do a model and then produce a wind footprint that's capable of measuring wind speeds at latitude, longitude coordinates with a very, very high resolution. So again, the resolution that we use is centroid of zip code, and you can see the picture of, I think this is Hurricane Jeanne, moving over South Florida east to west. And you can see the color coding and the different wind speeds. Again, this is just a picture to depict the wind footprint, but just like USGS Shake Map, there's all types of data points and very high resolution that underpin this very nice high-level picture. Now, a quick example of, since we have about 5 more minutes and then we go to Q&A, a very quick example is a wind speed exceedance at a number of specific locations. This client had locations, as you could see, indicated by those flags, all over the state of Florida. Some concentrations around Tampa and Jacksonville, but for the most part, spread throughout Florida. So if you used a cat in a circle type structure, the circle that you would have to draw would encompass the majority of the state of Florida, or possibly even all of the state of Florida. It would be very large, and then the probability of an event tracking through a circle around the entire state of Florida is very high, and you would have a very expensive cost. So a more efficient approach here, and particularly because the client was not asset rich. It was more of a servicing company where if a large hurricane event tracked through Florida and there was devastation to the area, they would lose business income. So it was less of a physical damage exposure that they had and far more of a BI loss. So a traditional property insurance program where BI is resultant from property damage, it wasn't the most efficient structure for them. So what they preferred strongly was a wind speed exceedance cover where we identified specific locations and broke the overall limit down by location and then set wind speed exceedance triggers, 96 miles an hour at the coast and 86 miles an hour for the inland locations, and then provided limits by location, but subject to a maximum limit per event equal to the per occurrence and term aggregate limit. We'll talk a little bit more about the specifics on this page. So again, very quick, high-level, rough term sheet here. Parametric hurricane property insurance policy, various locations throughout the state of Florida, each location designated by a lat-long coordinate. Policy was a 3-year term. Premiums paid annually at the beginning of each year. 100%, 50 million limit, again divided up by a number of locations because revenue or business income was spread out over a number of locations. And the payout was based on wind speeds exceeding 96 mile an hour at the coast, greater than or equal to 86 miles an hour for inland locations. And then as each location was triggered, a certain amount of that limit allocated to that location was paid per location exceeding the wind speed threshold. The last slide that we're going to talk about is just a few high-level points that Dave even covered early on, just to summarize. So for parametric covers, we look for independent data providers. So for Shake Map, we're looking at MMI, PGA, PSA as measured by USGS. There's no potential for influence by the insured or by Swiss Re, the insurer, or other insurers. For wind speed, we're looking at wind field or wind footprint provided by RMS H-Wind. And once again, independent third party, not influenced by us, not influenced by the insured. Timing, again, very fast, formulaic payout, like Dave said, 30 days or less. The coverage could be in insurance form or in derivative form. If in derivative form and the wind speed or shake intensity is exceeded, a payment is made. If in insurance form, a payment is made, and then there is either a 12 to 24-month period for the insured to do a simple certification that they had a loss greater than or equal to the amount that was paid to them. It's not the same cumbersome or complicated or lengthy claims process with claims managers and attorneys. It's just a simple certification by an officer of the company, of the insured, that they had losses greater than or equal to the amount that was paid. Now, why is that necessary for a parametric insurance product? Because insurance pays for actual loss sustained to indemnify an insured for a loss. So if a payment is made greater than a loss, or if a payment is made if there was no loss, then there's no actual loss sustained, and that compromises a fundamental tenet of insurance. So if there's any concern about a certification, then a derivative product could be employed where if the wind speed or shake intensity threshold is exceeded, a payment is made. There's no certification, just a simple financial payment, also within 30 days. In insurance form, the cover is extremely broad for all physical damage and direct or indirect physical damage and any expenses associated with the NatCat event. So although a certification is required, the coverage is extremely broad, and any basis risk or difference between derivative and insurance payout is minor, if any. And deductible for these products, there's none. No fixed dollar deductible. So I think that ends it. This is just a picture of the core team, and I think we're ready to go to questions.
Okay, ladies and gentlemen, as we move to Q&A, if you wish to ask a verbal question, please press #2 on your telephone keypad. You will receive a notification once your line has been unmuted, at which time you may then state your name and question. So once again, that's #2 if you would like to ask a verbal question. And as a reminder, if you want to submit a written question, please use the Notes tab and address your question to all moderators. And we do have a few written questions in the queue. The first is, will these slides be provided after the presentation?
Yes, the slides will be provided to all the participants. So I don't know exactly how that will be done, but it will be done.
Okay, our next question in the written queue comes from John. It reads, MMI is still a fairly subjective descriptive term. All of these triggers seem to have some squishiness to how a parametric might meet the trigger. Have you ever had disputes with insureds as to measurements? How was that resolved?
Yeah, the squishiness I'll talk about in a minute, but the triggers are agreed to and determined in advance. So those triggers or that payout factor schedule becomes part of the policy or the derivative long form. And there's no debate about what they are. And then also, there's no interpretation on the part of us or the insurer or the insured. There's a reliance on USGS or RMS H-Wind to report the parameters of the event, within a certain time period, and both insurer and insured are held to those third-party independent data provider parameters that were set. So there really is no, I wouldn't say any squishiness at all. In fact, it's quite formulaic, very precise, and it allows for that quick formulaic payout within 30 days or less. Now, if the squishiness comment was in regard to specifically to MMI, yes, it is a subjective trigger, but the MMI scale is derived from state, federal, USGS, seismographs, academics who measure, really all the data that's available to USGS combined with a modeled or interpolated modeled result to build out the resolution for areas where seismograph measurements are not made. So there is a bit of modeling, but it is independent third party. It's calling on all the data available from all the most accurate and scientific resources available to it. So I would say the independence and the technical merit of it is quite strong.
Okay, our next question reads, in the first slides it says cover is triggered if predefined event parameters are met or exceeded. So how may we assure all the factors of the event are defined in the beginning?
Okay, I think that's a very similar question to the one that we just fielded. So the parameters or the payout schedule, whether it's MMI, PGA, PSA for earthquake, or wind speed exceedance for hurricane, those are defined and made part of the policy in the payout factor schedule, and it's part of the policy. So there's no moving away from that. It's determined and recorded as part of the policy. Let me see if I'm missing any of that question. In the first slides it says cover is triggered if predefined event parameters are met or exceeded. So those predefined event parameters are what's in the payout table. So if let's say, going back to the Quake example, shake intensity, anything less than, again, I can't remember the exact thresholds that we used, anything less than a 6.5 MMI was not covered. Anything between a 6.5 and a 7.5 produced X% payout, then 7.5 to 8 Y payout, and anything over 8.5 MMI was another payout. So it's all very formulaic and spelled out precisely. If I haven't answered that or misinterpreted the question, write in again. Sorry about that.
Okay, our next question, and we have quite a few in the queue. Next question reads, how are the buyers of the bonds, or is this all, sorry, let me repeat. Who are the buyers of the bonds, or is this all Swiss Re Capital?
Okay, I'm glad you asked that question because the predominant number of parametric NatCat transactions that are done by us and others are in parametric insurance form. A number of others are completed in derivative form. There are also some that are done in catastrophe bond form. Now, those are probably the more rare. There's probably a longer history of catastrophe bonds for NatCat parametric solutions. They're predominantly done for insurance companies, and a catastrophe bond is done when the size of the transaction is very, very large, that either outpaces the capacity of the insurance market, or where you really need a broader distribution off into the capital markets to get, say, a $500 million to $1 billion bond done when much of the reinsurance market is already providing traditional reinsurance capacity to an insurer. There have been cat bonds done, I'd say a handful, for corporates, for non-insurance company corporates, but they're few and far between, maybe 3 or 4, and the vast majority are parametric insurance or parametric derivative.
Okay, our next question. Have you ever seen parametric cover for other weather events like prolonged fog event?
Prolonged fog, we're actually not my team here for the Americas, but my colleagues in APAC in Asia are working on a parametric fog index transaction for Singapore. I do not have the details of that, but I know it has not been done before, but they're in process providing that cover for a very large corporate based in Asia with concerns about Singapore and fog-related risk in Singapore. Maybe without diving in specifically on fog, there are a number of other parametric covers that are done that are maybe even in the corporate space more prevalent than even natural catastrophe, although corporate NatCat parametric deals are being done quite frequently now, much more so than many, many years ago. But the weather market, parametric rainfall covers, or combinations of rainfall and temperature, or snowfall covers, or lack of snowfall covers, or too much snowfall where you can't get onto a construction site and construction is delayed. There's lots of other clients or corporates that have exposure to other events that are not adequately covered in the traditional insurance market that are supplemented by parametric covers. Temperature and rainfall are more agricultural based, although snowfall and extreme low temperatures and extreme high temperatures are construction based. And then energy, you could have combination temperature, degree day, oil price, commodity price. So there are a number of other parametric covers outside of just natural catastrophes.
Okay, our next question reads, have other companies used parametric insurance to cover wildfire exposure?
There's a lot of interest in wildfire exposure, and we are working with a number of parties to design a wildfire cover, but I can't say in the corporate space, or I'm not even sure, quite frankly, in the insurance space that the wildfire cover was done. One of the approaches to a wildfire parametric cover is to look at geographic area impacted using satellite imagery. So we're looking at, obviously, with the drought condition in California now over or receding, the exposure is far less. But over the past several years, wildfire exposure, the utilities that are exposed to that, and others, there is a significant interest in wildfire parametrics, but none done in the corporate space to date. But we're working hard on it.
Okay, our next question in the written queue, Andrew Hall. NASA data has showed that hurricanes are increasing in strength and frequency, including maximum wind speeds. Are these wind speeds triggers dynamic? Is there a plan in place to deal with our adapting climate?
We agree with the statement made by Andrew Hall, or our atmospheric scientists agree with that. Parametric covers have the ability to deal with a full range of wind speeds. I think on the low end, we're looking at attaching them for step-up payouts with small percentage payouts as low as 74 miles an hour, the entry point for, in the Cat 1 area. And we've looked at covering them as high as Cat 5, 157 miles an hour. So the product is very adaptable to the increased severity of hurricanes. So it could accommodate that right now. What it comes down to really is good dialogue between insured, insurer, possibly modeling company like RMS, Equicat, AIR, and potentially others, to determine what is the desired coverage for wind speed exceedance in this case over what geographic area, and then taking into consideration what the budget of the client, the insured, is, how much limit do they want, what do they want the probability or the threshold, exceedance threshold to be. Obviously lower, the greater probability of the event occurring, so a higher price transaction. If you have assets that are not that susceptible to damage or vulnerability, then you may want to consider attaching wind speed exceedance at a higher wind speed threshold. So lots of flexibility with the product.
Okay, next question reads, how is pricing determined? In the past, this type of product was more expensive than traditional insurance.
Yes, great question. Pricing is a function of probability of the event occurring. So you'll typically see a price that is a multiple of the probability of the event occurring. So like Dave and I talked about earlier in the conversation, we're not concerned well, indirectly concerned about damageability or vulnerability to assets. What we're more concerned is about the probability of the event occurring at the agreed upon severity, wind speed exceedance or shake and fence. So now clients or insureds go two different routes. Some employ a modeling agency to help them determine damageability or vulnerability to their assets from certain severity quakes or windstorms. So that process helps them determine where they may want to set the threshold. So I would say it's not that we're not concerned or focused on damageability or vulnerability. We are, but it's indirect for a parametric product. So how they're priced, it is a function or a multiple. The rate online is a multiple of the expected loss online. And expected loss is driven primarily by the severity of the event and the area over which the coverage is desired. I think that covers it since we maybe have a minute or two left.
Okay, our next question reads, regarding cost price, what are the differences between traditional versus index-based insurance, and which has a higher cost?
It depends. It depends. I think I say it depends because there's the prior question also got at this point too. One of the negatives of parametric covers from years ago was that it was way more highly priced than traditional insurance. There has been price convergence over time. So I think everyone on the phone is probably going to find these products to be far more competitive with traditional insurance. But I think you need to step back from a cost comparison between traditional insurance and parametric products, because we would suggest, if not strongly suggest, that they're not looked at as one is an alternative to the other. We believe very strongly that parametric products are a good supplement or complement to traditional insurance. Now, why do I say that? They're used for deductible infill or buy up. They're used when you have uninsured or underinsured exposures or possibly inadequate limits that are bought. So parametrics, consider them a complementary product and a wraparound. But also, you're going to run into that insured that has a BI exposure that doesn't necessarily result from physical damage to their own property, but damage to the surrounding area and loss of volume of people or things. Then those are where parametric covers could be the primary product because traditional insurance doesn't take its place. So in short, there's been price convergence. Parametric products are very competitive with traditional insurance. Don't look at it as an alternative to, look at it more as a complement to. I think we're out of time, Tanya. We can take more questions if other people want to hang in there.
There are a few more questions in the queue. I'll go ahead and read the next one, and we'll take it from there. The next question reads, does proceed from parametric policy in non-insurance form subject to taxation when no direct damage is suffered by the insured?
Okay, we need to preface that by saying that the Swiss Re people on the call here are not tax and accounting experts, so any client or broker on the call should seek professional counsel in the areas of tax and accounting for these parametric products. However, if there is no loss and they recover, then they would be taxed as a capital gain on a derivative transaction, how they would be taxed normally on any other derivative. So with insurance, there is that actual loss sustained that the insurance product is offsetting. So the issue is not there for insurance products. You're offsetting a loss. In derivative form, you're usually offsetting a loss too, but there is potential that the derivative gain is more than the actual loss. So good question.
Okay, our next question reads, has Swiss Re implemented a storm structure for any wind farm asset owners to date?
A storm product for wind in the Americas, no, but I paused there momentarily because we are looking in Asia about a windstorm exceedance product for a wind farm or series of wind farms in Asia. Now, you would say, well, isn't wind good for power generation? Well, it is up to a certain speed. Once it starts hitting a point, then you start getting damage to turbines and rotor blades. And yes, we in the U.S. and all of the Americas have not had an opportunity to work on one of those, but colleagues in APAC, yes.
Okay. Is any baseline modeling work required from the insured, or is this addressed during the structuring underwriting process?
Again, it depends. We see some doing it and some not. And I think I talked about this a little bit earlier as well. Some insureds want to have third-party verification, technical assistance, and they'll employ RMS, AIR, EquiCat, others to help them determine vulnerability or damageability to assets for certain events and severity of events, and that helps guide them on what limit they should buy, what the wind speed or shake intensity exceedance threshold should be, how they step it up. So it's helpful, clearly helpful to do that. Is it essential in all cases? No, because you could have, for example, say a developer, a real estate developer with billions of dollars of assets and a 5% earthquake deductible for its assets, and that results in $100 million or more self-insured retention because of uncapped California earthquake retention or deductible. That developer has a pretty good sense that for a certain severity, shake intensity event in Northern California or certain magnitude, that they're going to have a loss inside that deductible. So we see clients or insureds cutting both ways. Some that want to work with RMS, AIR, EquiCat, or others to help to set the parameters. Others just say, I know, I have a gut feel, 6.5 or greater. I'm going to have some real damage. My internal engineers, engineering assessments during build and construction gave me a good sense of that, and we'll forego, and I have a good general feel that I want to do either a binary or a step-up starting at 6.5, exiting at a high level, and just go with that. So it really happens both ways.
Okay, I think we may have time for one more question. We do have two more in the queue, and participants, I'll make sure that speakers receive all submitted questions. So our last question for now is, if there are event triggers that lead to a payment but the actual damage is less than the amount paid, do we ask for reimbursement for the insured? What does this process look like?
Okay, great question. In insurance form, yes. In derivative form, no. So since it doesn't apply to derivative form, let's just talk about insurance form. So that whole payout process, let's go back. An event, let's say the hurricane occurs in the general area where we're looking at insured locations. So what happens is the insured sends a report that a suspected eligible event occurs. Then we, as calculation agent, the insurer is calculation agent in the contract. We then get data from National Hurricane Center, from H-Wind Scientific, or RNS H-Wind, and then determine whether the suspected eligible event is an eligible event. We have a certain day count to do that. We issue a report with all the supporting documentation from NHC and RMS H-Wind, independent third-party data from them. We submit a report to the insured. The insured has time to review, and then we make a payment after the report is given within X number of days. And that whole process happens within 30 days to meet the 30-day window of payment. So now, because of that basic tenet of insurance that you can't have a payment for anything other than the actual loss incurred or sustained, then that's the process that we outlined earlier too. We agree in the parametric insurance contract whether the insured prefers to have 3 months, 6 months, 12 months, 2 years. Some want a short period, some want a long period. And we give them whatever period they want within reason. 24 months has been the longest period for them to assess the physical damage, the indirect BI, time element, extra expense, and any other loss related to that event, and then certify that they had a loss equal to or greater or, quite frankly, less than what we paid them. So in the example, if we had paid them $50 million for the maximum trigger in the parametric insurance contract, and then it turned out after a 12 or 24-month period to assess, they determined that they only had $45 million of losses that they could certify, then there would be a repayment requirement, a reimbursement requirement within X number of days, also contractually agreed, where they would repay us the difference between the $50 million that we paid them in 30 days and their $45 million actual loss sustained. Now, if there's a substantial concern about that certification and reimbursement process, then we usually suggest that the insured or the counterparty transact in derivative form. However, not everybody wants to transact in derivative form. So the closing remark would be that the basis risk or difference in payout between the insurance and the derivative contract we found is very small, if possibly even non-existent. The breadth of the cover of the parametric insurance policy is as broad as Dave and I said. It's all indirect and direct physical loss or damage and any expense related to the transaction. So you have very broad cover and the greatest ability to recover the full amount of that payout, subject to the thresholds exceeded. Great question, though. We get it all the time.
Okay. And did you want to take any more questions at this time?
Are there any more in the queue?
There are 2 more in the queue.
Okay, let's take another one. I mean, if anyone needs to leave, they can leave, I guess.
Okay. So the next question reads, going back to capital sources, are there any capital adequacy standards imposed by any regulatory body as with an insurance commission?
Well, when the transaction is done in insurance form, it's subject to the same regulations that insurers, the entities that issue these policies, are regulated by. So now we issue both parametric insurance and derivative form. So our regulators do watch how much aggregation we have in derivative form, and there's a certain amount that's allowed. I'm not at liberty to discuss that over the telephone, but it's a very large limit. And then once you exceed that limit, then there are greater regulatory requirements and reporting requirements required. It doesn't mean you can't exceed the limit. It just means reporting of the individual transactions and the aggregate number of all derivative transactions is heightened. So capital adequacy, going back to the catastrophe bond model, catastrophe bonds are a collateralized instrument. So funds flow from capital market investor to insurer or SPV, special purpose vehicle. They're held in trust to pay a loss if and when it occurs, and then return to investors if the event doesn't occur over the policy period. So cat bonds are fully or almost fully collateralized, provided the insurer that's acting as the transformer mechanism isn't taking risk on its own. But parametric insurance, insurance regulatory, derivative regulatory bodies, yes. So from that standpoint, capital adequacy for insurance regulation and derivative regulation applies.
Okay, and our final question, would Swiss Re be able to price a parametric insurance structure for a wind farm asset owner that would pay out for an event of lack of wind? This anticipates that no damage event has occurred, rather a lack of wind event that causes the asset owner a financial loss.
Yeah, in that case, the loss is not resulting from physical damage. The loss is resulting from lack of wind. So there is an actual loss. It's a business income loss. So that could be done in insurance or derivative form. We could consider that transaction, and we do actually transact in irradiance transactions for solar renewable solar farms, and also for lack of wind over certain critical days or day count for wind farms too. So the simple answer, yes.
Okay, and finally, will the recording of the presentation be made available to participants?
Yes.
Yes.
Okay, great. There are no more questions at this time.
Okay, well, thank you, everybody. We really appreciate your time. We hope the discussion was informative. And please reach out to us. Our contact information is in the presentation as well that you'll have. And we would be very happy and eager to entertain further discussion. Dave, anything else from you?
No, we're good to go. We look forward to receiving further inquiries.
Great. Thank you, everyone.
Thank you all for joining today's conference. The call is now concluded, and you may disconnect.